Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, also known as Mr. Valuation. And once again, it's my pleasure to welcome you to another Subscriber Request Tuesday video. Today, I'm going to be looking at Intel corporations. And I will, if I have time here later in the video, kind of feature against some of its main competitors, mainly AMD and NVIDIA, because this is actually a very tough sector or tough industry to invest in right now, but for different reasons, which I'll showcase here in a little bit. But, as I think many of those who requested Intel know that the stock was down a couple of days ago, about 10% on the day, roughly. And they actually had a pretty good earnings report. But the problem had to do with guidance, and I'll be covering that thoroughly as I go through the video, what management was guided that they're going to be doing, especially with capital expenditures. And then there's a lot of fear of what this could mean to the company going forward for the next couple of years at least. Now, in theory, management is proposing to take some short-term pain so they can, get some long-term gain. And I guess the question is, a lot of analysts aren't really totally sold that they're going to be able to pull that off. So it's a very interesting story. But let's start by just looking at it, running through Intel through the paces of the FastGraphs Fundamentals Analyzer software tool. And let's start with adjusted operating earnings. So here you see a couple of things that should immediately strike you is, number one, that as a semiconductor manufacturer, the company's earnings are what I would call moderately cyclical. You can see, during the recession of 2001, they had a 68% drop in earnings, followed by a negative 4%. Then they had a couple of good years. And then as they came into the 2008 Great Recession, they had negative earnings growth for 2 consecutive years. And then here's the little COVID recession, very short-lived. You saw the stock price drop, but it didn't really affect them as a operating business. They actually ended up eking out a little bit of earnings growth. But now earnings growth is expected to fall precipitously by over 30% for fiscal 2022. And it's expected to be flat to slightly down for this fiscal year, which of course ends in December. We're only about a quarter away from that fiscal year ending. Now, you should also clearly see the relationship between price and earnings here, that in the long run, the stock price goes where the company's business goes. But because of the cyclical nature of Intel, I also want you to see that there's a lot of volatility here. Now, the company's earnings growth over this time frame, which goes back to 2001, has only been about 4.6%. Now, occasionally, like we see from the period here, beginning in 2013, occasionally you see some spurts of really strong earnings growth. You had earnings growth in 2016, actually, of 17%, then 27, then 32, 6, and 9. So this was a very strong period, and you can see the stock price was very strong as well. But also, again, I want you to note the volatility of the price. There's a lot of internal volatility in the stock price of Intel along the way. That's really part of the nature of what I would call the typical quasi-cyclical or semi-cyclical company, especially in the semiconductor space like Intel. Now, what you also should note is the consistency of the dividend record here. The company's grown their dividend very consistently over this time frame. They started raising their dividend in 2004 after holding it level for 01, 02, and 03. But then you can see they increased it from 16 cents to 32 cents during the good times here, then to 40 cents, 45, and so on and so forth. The company pays out about 38%-ish, 35 to 40%, we'll call. Here's 25%. Depending on how good their earnings are or not, that payout ratio is obviously going to vary, but it's been a very consistent producer of income, and I'll get more into that later. Currently, the stock offers a 2.5% dividend yield, and earnings yield over 10%, and as many of you who followed my work know, I'm looking for a 6.5 to 7% minimum. So this looks very, very attractive at 10.69. But, as the old saw goes, statistics don't lie, but statisticians are darn liars. You've got to be careful that you are using data correctly, because data is always relative to what's going to happen going forward, as well as what's happened in the past, all right? The blended PE is under 10 right now, but that's based on a high level of earnings. If I'm looking at earnings, going out to 2022, then, at $54 a share, the stock could be trading at a $54.75 price. It's currently, trades around 49-ish. So, it's a lot higher than that if you're looking at future earnings, the PE I'm talking about. But currently, it's only about 9 times earnings, but earnings have been strong for the last couple of years. The company only has about 26% debt, and it is rated A+, so it's a very attractive looking company. Now, I want to go through some other very important metrics here real quickly. I want to go and look at operating cash flow, because this is very important when I'm looking at the dividend. Now, I don't necessarily try to value the stock when I'm looking at operating cash flow. And I want to stop and interject a point here. I do these videos and I get comments sometimes, the company's cash flows are horrible or their free cash flow is horrible, yet I cover them in the video. So they either didn't watch the video or didn't know what they were looking at. So I want to be very clear here. Operating cash flow, for the last couple of years has been, in 2020, it was $8.36, covering a $1.32 dividend. You can see this orange line on this graph here, which is operating cash flow, has covered the dividend like a blanket for all these years and continues to. Their operating cash flow payout ratio is in the teens, 15%, as high as 20%. 23%, but it's obviously the area below this white line represents the portion of all these cash flows that they're paying out, and their payout ratio of cash flow is very, very attractive. Now, free cash flow is the real acid test when you're looking at, examining a company, especially if you're concerned about whether they pay the dividend. And here's now where the rub starts to get in. Now, number one is free cash flow has also covered the dividend, which has been very, very strong. And free cash flow is operating cash flow minus CapEx. And operating cash flow already includes what it costs for the company to run their business. So in other words, free cash flow is what's left over, what the company has left over. And even after covering all their expenses and considering CapEx, the company has had more than ample free cash flow to cover its dividend. What the problem is, what the company announced in their most recent earnings report, and you can find that on a lot of sources, including places like the Wall Street Journal, etc., is that the company actually announced that they're going to dramatically increase their CapEx. All right, so this is the formula for free cash flow. I just wanted you to see there, but the company is going to be introducing a lot of CapEx, and I'm going to get into that in more detail. This was an article in the Wall Street Journal just a couple of days, and it says they logged their worst day. That was the 10% day that they dropped, as capital plan raises margin concerns. And I want to cover that in some detail with you. There will be some issues, but they're generally CapEx is around 15 to say 17 billion. They're talking about going up to 25, even to 28 billion of CapEx in the future. And that's why we're seeing this idea that free cash flow could drop dramatically, going forward. So that's one thing that I think you really need to be focused on here, is this idea that the company's business is going to change dramatically from a standpoint of their ability to generate free cash flow going forward. Free cash flow is expected to, not be covering the dividend over the next 2 or 3 years. If I go ahead and go into the forecasting calculator, I want you to see how severe this is. So what's interesting is the numbers look attractive. The company's trading at a low multiple of earnings, low multiple of cash flow based on history. But looking forward, especially when you look at free cash flow, there could be some problems that the company is facing. And that's why, these analysts and so on are talking about, Intel having some issues over the next couple of years. And this is what I referred to when I first mentioned the stock, about the company's willing to take some short-term pain in order to make long-term gain. That a significant increase in CapEx is expected to be material, and that's something that I did want you to be aware of. Now, I also want to talk about a little bit about operating earnings here for a moment, and go ahead and go into forecasting operating earnings for you, because I want you to note something, and this is one of the real benefits of fast graphs. If I'm looking at 2021 estimates, 6 months ago, analysts were expecting 461. Then they raised it to 480, and currently the estimates are for 528, and we're getting pretty close to the end of the year. I think this is pretty good. So the company has done well. Their last earnings report, they did beat. I do want to point that out. The problem is looking forward. These analysts, these people that are paid, and this company is really well followed. You can see there are 41 analysts reporting to FactSet here. These people that theoretically know the sector, know the business, know the competition, are expecting Intel to have a minus 31% rounded earnings drop next fiscal year. Now, they were forecasting 6 months ago 466. Then they lowered it to 450. Then they lowered it to 446. And now, after the most recent earnings report, they've lowered it even more to 365. And then they're expecting modest growth or to flat growth in 2023 and 2024 before they expect some of these, things that the company's doing to go ahead and kick back in again. So there are some what I would call real short-term issues with Intel. This is not a stock that looks like it's poised to do real well over the next year or two. And this really brings up the question, what kind of investor are you? Okay, if you're a long-term investor and you're looking to invest in a stock for, permanently, as Warren Buffett says, the best holding period is permanently, then you want to be looking at, 3 to 5 years out. Might be willing to look past that. But if you're practical and prudent, you also, I think, need to be aware of the fact that this stock has some issues facing it over the next couple of years. It's very unlikely that this company is going to produce great earnings, great cash flow, and certainly great free cash flow results coming up here. So let's go ahead and move into fund graphs, financial underlying numbers. Let's look at some of these important metrics that are having all this impact on the company. Now, what I'd like to do, I'm going to go into the in millions graph here. And the first thing I want to do is I want to talk about common shares outstanding, because I think that's something that you all need to be aware of here. And that is that Intel has been buying back their stock. Now, this company has been, reasonably inexpensive over this time frame, as I showed you earlier when I was looking at the fast graphs here. When you're looking at Intel stock, it's been trading at low multiples for quite a long time here. So that tells me that, this was a reasonably prudent exercise, especially considering how their cash flows, free cash flow and operating cash flow, were covering the dividend, et cetera. So from that standpoint, I think that's a plus for the company. They have been buying back stock when their stock was cheap. I know a lot of people call that financial engineering. I hate it when I see the price being to a level where I wouldn't buy the stock back, but I like to see management returning capital to shareholders through buybacks when their stock is cheap. So that's just, a difference in how people look at things. All right. So other things that I think are critically important. Let's look at CapEx now, because this is what really is causing, I think, a lot of the concern. As you can see here, the company's been spending $11 billion, $15 billion, $16 billion. If I look at this in terms of quarterly data, you can see that they've been, $3 to $5 billion a quarter in income. Management has announced that they're going to increase that absolutely exponentially to like 25 billion going forward. So when I'm looking at, this yearly CapEx, this number is going to increase dramatically. Now, what that's going to do is that's going to have a significant impact on operating cash flow, because here's operating cash flow minus the CapEx, which has really given us the free cash flow number, okay? And that's, what I've drawn here now. So, free cash flow, even despite CapEx, which is the kind of the lighter purple, and then the dark purple or dark blue line right now is the free cash flow, has been, covering it. But going forward, that number is going to increase dramatically. Now, the other issue that I think we need to look at is gross margins. The company's been generating gross margins in the 50 and 60% range, quite consistently. So that's been a real good thing for the company. The net margin has also been reasonably strong in the 15 to even more recently, the 29%. And their quarterly net margins have been holding up real well, and their gross margin have been holding up real well. Now, analysts are afraid that all this CapEx spending that I talked about is going to destroy these margins, okay, and is really going to hurt their growth. And that's something that is really concerning, because, the reality of it is, if the company's growth is really impacted, then you're looking at, as I said earlier, a couple of years of probably very poor performance. This company is theoretically positioning themselves for the future growth, but they've got quite a challenge to pull that off. That's not necessarily a slam dunk idea. I just want to make that clear. All right. So there are some challenges facing this company going forward. Now, if I go back and look at, Intel historically, I think there's another factor here that I want to make sure that all investors understand. Valuation is critically important when you're looking at a company. And, growth is also important. Now, I've got a slightly different time frame here. I'm going back to the current version of fast graphs. You're looking at 3 or 4% earnings growth here, because I'm only including a couple years of estimates. I didn't include as much as I did on the other graph. And if I look at performance, you can see capital appreciation has been only about 2.5% during a time when the market grew by 6.6. Now, the company did throw off a little bit more income than the S&P 500. So it's been an income stock. It's been a decent performer, but this has not been a spectacular business. Now, of course, that's measuring it when the valuation has fallen. I also want you to note the 10% drop that you see on the graph here is really not that onerous when you look at it in the perspective of the longer term. But Intel is facing some real potential issues going forward. And again, the estimates have changed dramatically on the stock. And that's one of the advantages of having fast graphs is that you can, keep up with what analysts are expecting and what's going on. I'm going to also put the normal multiple on here. The stock has traded at a premium multiple between the two great recessions. But then if we look since the great recessions, it's only been trading at about a 12 multiple. So, there are some issues. But now let's talk a little bit now about their competition a little bit, because here's the conundrum that I also see. If I look at AMD, for example, which is, probably their most formidable competitor right now. Also NVIDIA, which I'll show you here in a moment. If I look at these two companies, I want you also to notice that Advanced Micro Devices has had really extremely cyclical historical performance. What's interesting, for the last 4 or 5 years, or last 3 or 4 years, they've been outperforming Intel dramatically. Now, there's a lot of growth going on right here, and this is something. So you see the stock price over the long term growth has been anemic at only 2%. But if I shorten this, and this is the dynamic nature, this company has been growing at 35% a year, and that somewhat, rationalizes why the market's been putting such a high multiple on the stock. But having said that, if I look at this stock long term, the analysts, there are again a bunch of analysts following AMD as well, expect 15 to 16% growth over the next 2 or 3 years. 90% growth this year. Right now they're obviously eating Intel's lunch, and expected that growth to be, maintained in the double digits through 2023 before going back into single digits. The long-term growth prospects for the company is expected to be 32%. And again, there's a bunch of analysts, producing that. So the reality of it is here, this company looks a lot more attractive from an operating point of view than Intel right now. The problem is the valuation is high, and whether it's an attractive entry today or not. Now, had you bought it 3 or 4 years ago, that would have been an excellent buy relative to Intel. I just picking a time here. If you'd have bought it in April of 2018, you'd be averaging just incredible rate of return. AMD has been a great performer for the last several years. Now, the next formidable competitor that's in this space would be NVIDIA. And if I look at NVIDIA, you see a very, very consistent operating history in recent years. Longer term, if I look at this stock longer term, it has a significantly better record than Intel or Advanced Micro Devices. Again, the problem is, even considering the great performance that it's done lately, the valuation is real high. So that's where your conundrum is. If you want to be in the semiconductor space, these are probably your best 3 choices. The problem is Intel is facing some significant issues going forward, as I pointed out. NVIDIA and Advanced Micro Devices look like they're going to be producing some really good numbers going forward. But the problem is you've got to pay very, very dearly to invest in those now. So, what do you do with Intel? For disclosure, I'm currently long Intel. I'm actually considering moving out of the position. I don't have another position to go into in semiconductors at this point that I'm excited about. But just for defensive purposes, if I can get a little bit of stability in Intel, I'm probably going to come out of it and then look for another place to go, because I don't believe the future is going to be that great. Now, if the management pulls off what they're trying to pull off here, this could be a tremendous time to be watching Intel for a potential purchase, possibly next year or the year after. Anyway, that's my view of Intel right now. This was a subscriber request. I hope you got a lot out of it. You want to analyze these companies, from soup to nuts, if you will. And I do want to point out, I don't believe with fast graphs we rely on analyst estimates. What we do is we evaluate them, because you have to forecast if you're going to be a long-term investor. And you have to be realistic. You can't buy the past. You can only buy the future. And I want everyone to remember that. And there's nothing that, in my view, supplants good comprehensive research and due diligence. Okay, now, the first step to do that is go into the company's website. You can go into Intel here, and you can learn an awful lot about what the company's actually doing, as a business. You can look at all their various products, all the things that they do. It's a very complex company, if you will. But then, of course, the one thing that you want to do is you want to go into investor relations. And right now, they've got a very nice third quarter earnings presentation by Pat Gelsinger, their CEO, is basically leading it here. And they talk about growth of earnings and revenues. And the company did pretty well here. You can go through this presentation. They've got a good pipeline. Their gross margins, as I mentioned, were in the high 50% range. Their revenue was up 5% year over year compared to last year. Their earnings were up 59% year over year, which I illustrated when I looked at when you look at the fast graphs here and look what's expected. For this year, you see a pretty good number, but that's only for the quarter. I do want to make that clear. So that all looks good. Now, here is a breakdown of some of the various, divisions of the company that you can also look at. But this is where the problem happened when they start talking about outlook. They felt revenues were going to be down. The gross margin was going to drop into the lower 50% range, but management is still arguing that they're going to maintain 50% plus margins. Apparently, analysts don't agree with that, and they think earnings are going to be down 39% year over year. This is looking at the fourth quarter of this year, and of course, and then beyond. And then if you're looking at the whole fiscal year, they think they're going to average 57% gross margins. Revenues will be up 1%. Earnings will be up about 4%. Capital expenditures will be in that $18 to $19 billion range, and free cash flow will be about $12.5 billion. But as they go forward, they feel that the gross margins are going to stay in the 51 to 53%, but analysts aren't buying that. I want to make that clear. Then moving upward after that, here's the rub. They're talking about investing $25 to $28 billion of capex in 2022, which they believe is going to give them the potential for growth in subsequent years. And, they're also committed to a healthy and growing dividend. If there's one salient factor, is that they do still, at least management is still saying that they're committed to maintaining that dividend despite what might be happening with free cash flows. Anyway, there you have it. That's Intel. I hope you enjoyed this video. This was a subscriber request. You asked for it and I gave it to you. Don't shoot the messenger. It is what it is. This is what Intel looks like right now. If you like this video, give me a like, ring the bell, share this with others if you will. And if you are not already a subscriber, please subscribe. And also, you might want to take a look at FastGraphs, the Fundamentals Analyzer software tool. We're real excited about the opportunities to really increase and enhance the value of this tool to our subscribers. Thanks for watching.